Keep more money in your pocket and pay less taxes. Here's what you need to know when filing your taxes this year in Canada if you are a home or property owner. You can claim up to $10,000, which equals a $1,500 refund for the purchase of a qualifying home in 2023 under the first-time home buyer's tax credit if you haven't lived in a home owned by you or your spouse in the previous 4 years. A qualifying home must be registered in you or your spouse's name in accordance with the applicable land registration system, and it must be located in Canada. Simply claim $10,000 on line 31270 of your tax return. This home buyer's tax credit is also applicable for people with disabilities. So if either you or your spouse meets the CRA eligibility requirements for a person with disabilities, you may be able to enjoy the home buyer's tax credit even if you aren't a first-time home buyer. The next thing is the GST on new housing rebate. The GST new housing rebate allows an individual to recover some of the GST paid for a new home from a builder, or if you hired a contractor to substantially renovate a house that is for use as your or your relation's primary place of residence. This rebate also applies if you purchased shares in a co-op for the purpose of using a unit in a new or substantially renovated cooperative housing complex, or if you purchased a new or substantially renovated mobile home for use as your primary place of residence. For the forms and documents required, visit the GST HST New Housing Rebate page on the CRA website. Home accessibility expenses. If you or an eligible family member incurred expenses in 2023 for improvements to your principal residence or the land necessary for the use and enjoyment of that residence, you can save taxes on an eligible renovation costing up to $20,000. A qualifying individual is one who is eligible for the disability tax credit, or an individual who is over the age of 65. Eligible expenses are expenditures of an enduring nature and must be integral to the home or the land that allows the qualifying individual to gain access to or be mobile or functional within the dwelling. To claim home accessibility expenses, complete the chart using the federal worksheet and enter the result on line 31285 of your tax return. Next is rental income and expenses. Do you own real estate, including farmland, that you rent out? If so, don't forget to declare your rental income on your taxes. And you could claim allowable expenses such as advertising fees, property taxes, insurance, and interest on money you borrowed to purchase or renovate the rental property. You could also claim capital cost allowance, or CCA, as a deduction on renovations to your rental property as a depreciating asset. Note though that while you can claim the renovation costs in the year they're completed, when you sell the property, you might end up paying taxes on the value of the CCA claims via capital gains. Because of this, you'll want to exercise care when writing off anything related to renovating your rental property. You will have to fill out form T776 for this. This one is new for 2023 and is called the Multi-Generational Home Renovation Tax Credit. Starting January 1st, you may be eligible for up to $7,500 in support for constructing a secondary suite for a family member who is a senior or an adult with a disability. You can claim up to $50,000 in qualifying expenditures for each renovation that is completed. The tax credit is 15% of your costs, up to a maximum of $7,500. Use Schedule 12 and claim the amount on line 45355 of your income tax return. Do you work from home? You can deduct expenses you paid in 2023 for the employment use of a workspace in your home, as long as the workspace is where you mainly, more than 50% of the time, do your work and use the workspace only to earn your employment income. You can deduct the part of your costs that relates to your workspace, such as the cost of electricity, heating, maintenance, property taxes, and home insurance. However, you cannot deduct mortgage interest or capital cost allowance. You must complete Form T777 and get a completed and signed Form T2200 from your employer. So what about the temporary flat rate method? In 2020, many Canadians were required to work from home due to the pandemic, and the temporary flat rate method was introduced to make claiming home office expenses simple and straightforward. The temporary flat rate method no longer applies for the 2023 tax year, unfortunately. Moving expenses. When you move more than 40 kilometers away to attend school full-time, launch a new business, or take a new job, your moving expenses could be tax deductible. Moving company bills, hotel bills, and legal fees are just a few of the eligible moving costs you can claim on line 21,900 of your tax return. Now, there are also programs available for those who are looking to purchase a home in the near future. The first being the Home Buyers Plan, or HBP. If you and or your spouse are a resident of Canada with qualifying registered retirement savings plan or RRSP contributions, one or both of you might be eligible for a tax-free withdrawal towards buying your first home. Under the HBP, first-time homebuyers or previous homeowners who haven't owned a home in the current year or the preceding 4 years can withdraw up to $35,000 tax-free to use towards the down payment on a home. There is one thing to keep in mind though, you do have to repay the borrowed amount via RRSP contributions within 15 years back, starting 2 years after the withdrawal, and if withdrawals under the Home Buyers Plan aren't paid back, they'll become taxable. The second program is the First Home Savings Account, or FHSA. An FHSA is a registered plan which allows you, if you are a first-time home buyer, to save, to buy, or build a qualifying first home tax-free. If you opened an FHSA in 2023, you can claim up to $8,000 in your contributions that you made by December 31st as an FHSA deduction on your 2023 tax return. Lastly, what if you sold a home? When you sell your home, or when you are considered to have sold it, usually you do not have to pay tax on any gain from the sale because of the principal residence exemption. This is the case if the property was solely your principal residence for every year you owned it. If you sold your property and it was your principal residence, you do have to report the sale. The CRA will only allow the principal residence exemption if you report the disposition and designation of your principal residence on your income tax return. If you forget to make this designation in the year of disposition, it is very important to ask the CRA to amend your income tax return for that year. The CRA will accept a late designation in certain circumstances, but a penalty may apply. What about property flipping? Starting January 1st, 2023, any gain from the disposition of a housing unit, including a rental property located in Canada that you owned or held for less than 365 consecutive days before disposition, is deemed to be business income and not a capital gain because it is considered property flipping. However, there are a number of unexpected life events, such as a breakdown in marriage or a death, that may exclude the property from being deemed as a flipped property. At the end of the day, when you're offered money in the form of tax credits, why wouldn't you accept it? Taking the time to investigate which homeowners' tax credits you qualify for this tax season could help you keep more of your own money in your pocket. Now you just have to figure out what to do with it.